Hello and welcome back to the AI Pathfinder for Private Equity podcast. AI Pathfinder helps private equity firms make sense of AI and make it work. It's an expert network built on insight, experience, and connection, bringing the right people and ideas together to turn AI from something firms are curious about into something that delivers real results. If you'd like to attend one of my regular AI strategy briefings in London and New York, please check out the show notes for details. This is the fourth episode in our AI operator series. Today, I want to broaden the lens slightly and bring a venture capital perspective into the mix. Because whilst the deal profile is different, the challenge of building AI capability inside an investment firm and across a portfolio is going to be somewhat similar. My guest is Ties Boukema, Head of Data, Tech and AI at Dawn Capital. Dawn is one of Europe's leading B2B software investors. What makes Dawn particularly interesting for a conversation like this is that they've built proprietary internal AI platforms that have been publicly recognized, including a Forbes feature on how Dawn is using AI to supercharge relationships. So this is a firm that isn't just talking about AI native operations, it's genuinely building them. Ties himself brings an intriguing background, studying law with time at Deutsche Bank, Google, co-founder and data and AI training firm Cognitas, and now 3 years plus at Dawn Capital, where he's built out the data, tech and AI function from the ground up. Ties, welcome to the podcast.
Thank you, Steve. Great to be here.
Fantastic to have you here. Looking forward to getting into the conversation. Look, first of all, want to learn a little bit more of your backstory and your route into venture capital. You've studied law, you have 5.5 years at Google, you built a data and AI training firm, and then you joined Dawn in early 2023. Could you tell me a little bit more about that journey and how that led you towards VC in Dawn to kick us off?
Yes, minor correction. I did a law degree and a stats degree, which makes it slightly more logical, I think, that I ended up on the data side. Better question is why I did a law degree to begin with. And the reason is my dad is a lawyer. His dad was a lawyer. His dad was a lawyer. So when I was 17, I had a deep talk with my dad. And he was like, you can sort of study whatever you want. So you can do intellectual property law. You could do M&A. You could do real estate law, as long as it was law, kind of. I broke his heart and did not become a lawyer. I did 2 internships in investment banking where I liked many aspects, but from a tech perspective and sort of process innovation, it was a lot less exciting to me than some of these big technology firms, particularly Google, because Google also did lots of stuff that was not purely commercial. And the main thing that drew me was not the driverless cars, but was that they had teams trying to apply AI and machine learning on medical scans. So eye scans, breast cancer scans, vein scans. So I've had a brain condition since birth called hydrocephalus, which means basically have too much water around your brain. And my condition was very severe as a kid. And I've been kept overnight in a hospital more than 200 plus nights in my life. And I was basically a very, very, very sick kid up to age 20. I'm 6'5" or like 196 meters tall. I was 165 pounds or 67 kilos when I was 20, which is not a great look. It's hard to go shopping with those dimensions. And that was fixed at age 20 because a doctor diagnosed me correctly. And then I had a surgery. And as a result, it seemed really exciting to get to work at a place that also applied some of their brightest minds on this. So I spent 5.5 years at Google in various data and machine learning roles, always trying to become technical enough, especially on the data side, to be able to get into a team at Google Health. When I then was lucky enough to do a rotation there, it wasn't as exciting or fulfilling as I would have hoped, because I think there's many things nice about the Google brand, but the Google's health division, I think, is a little bit hamstrung exactly because they're associated with Google Ads. And the headline, Google can see your, prostate cancer screening images is so terrifying for both sides, right? For both the hospitals that would give this data and for Google widely, that actually they move slower than some startups would. I then had my first quarter life crisis because I thought this has been my calling in life, and this is where I was going to work until Oprah Winfrey would call me up and ask me to do a book and do the show. And then a mentor of mine said, hey, there's this team in our finance division that is an engineering team. There was this whole acquisition that we did where none of the reporting and the revenue forecasting systems are created from an engineering perspective. They're all basically built by accountants and very Excel heavy. As a result, it just doesn't scale because the scale of Google is just nuts. I mean, the team that I ended up leading the revenue forecasting and reporting and making the slides for the execs and et cetera in EMEA 4 was about $30 billion of revenue, which is, it's not going to scale with Excel. And whilst sort of setting up the plumbing correctly for that function and making that more in line with how regular Google ads or hardware or the other parts of Google basically ran their finance team. I was at a dinner with a bunch of private equity and VC friends. And then I realized that, a couple of them had to leave dinner early because they had to triple check like 3 portfolio companies that they sat on the board of as an observer for quarterly reporting. And my jaw just hit the floor. I'm like, these are massive PE firms that could easily build this in-house and should build this in-house, or they're cutting edge VC firms that have like invested in some of the cutting edge data companies that do this and the software companies that do this. So they clearly both believe in the power of big data and software, because otherwise they wouldn't put their dollars there. But then internally, they just haven't adopted it in a way that, the average sort of Series B company has approached this problem. I think I was even more Dutch and outspoken then. A pretty blunt Dutch sort of brand where I was like, well, the only reason you people work so hard is because you guys aren't smart enough to use enough technology. And I think there's some nuance I've learned over the years, but there's some truth to it still, which is that technology can just scale infinitely better than humans on many, many, many applications. And something as dry as portfolio reporting and monitoring. And that is a great example where if you think about it tech first, you can make a massive dent in it. Interviewed with a couple of firms, had a really, really good connection with Dawn culturally, because Dawn was the only firm really where when I mentioned, hey, I've set up a similar system at Google that would be very applicable to your quarterly reporting. I know I'm on probation for the first 3 months, and I know I'm not going to pass probation if I don't deliver. And I want to go do this for you. A lot of the US firms were much more risk averse, where they were like, ooh, but the other prestigious sandhill funds haven't done it. And like, if they haven't done it, then it must be really difficult and it must not work. And I'm like, but if it works for $30 billion of revenue, I think it'll handle your 80 portfolio companies. And they're like, yeah, but we have these really complicated portfolio companies. And it was infuriating.
Yeah, a lot to unpack, and we're not going to unpack everything. But what I will say to the listeners is that you sent me a podcast before we arranged this, and it's definitely worth a listen because you go into a little bit more detail on your condition and the process that you went through and how you sort of got into Google. And I'll put that in the show notes so people can sort of listen to that if they wish to go in a bit more detail. And it's definitely worth a listen to. Fascinating. But what I get out of this is you want pace, you want speed, and you're frustrated if it doesn't translate quick enough into results. But the tech is there. You have the confidence in the technology to enable something to happen. And so, if we go then into your role at Dawn as head of data, tech, and AI, on the surface, it looks like quite a broad remit, and certainly from the other AI operators that I've spoken to. And I just wonder if that shape was deliberate from the get-go, or has that just evolved as you and they have sort of grown with you?
The initial scope of the role was data, particularly on the data and setting up the architecture, because there was no data warehouse, and there was very little in terms of tech foundation. Like there was a CRM, and thank God they were on Google Workspaces instead of pure Microsoft, but there wasn't that much. The big moment when I think the job expanded is when it stopped being how do we get portfolio reporting and how can we get like IR questions answered much faster to enable an effective fundraise, which is probably the first maybe 4 months of the job, into my big moment. Because I always thought I would actually end up spending all my time on building sourcing models, like what you would do at a hedge fund. And I think VC roles are different than PE funds. We're typically on the VC side because we have minority stakes and there aren't just that many dollars flowing out. And a lot of the tech companies you invest in should have their tech in a good place, right? Like it would be very worrying if I have a chat with an hour with one of our founders and they go, oh my God, I've never thought about this. I'm like, you should have really thought. Like this would be a huge red flag, right? It's part of the DD, whereas on the PE side, that isn't as worrying necessarily. So as a result, VC roles tend to be almost entirely internally focused, and a lot of these PE roles tend to be very heavily portfolio focused. So the big thing I thought I would be doing once I got sort of some of the core plumbing and finance data in shape is data-driven sourcing. And it took me maybe 6 months or 5 months to realize that was not the most exciting thing to focus on for us, because we're a Series A and B investor. There was a deal in France, I believe it was Penny Lane, which ended up doing really well. And we've been trying to get into that deal. And basically, we struggled to get great contact with the founder and to really have a proper meeting with our GPs and where everything is lined up and we can properly try to convince the founder that they should pick us over other firms. And by the time we finally have the meeting with the founder in Paris, the founder goes, thank you so much, but I took money from one of the big US firms, one of the firms where actually that investment partner sits on a board with one of our founding GPs. So our founding GP, begrudgingly congratulates this person on winning the deal over us. And 2 people message him afterwards from that board and say, well, Norman, we've been on the board for many years with you. We really like you a lot. And me and Anna were both angels in this deal, and we've known that CEO for a long time. Why don't you just ask for an intro? So he storms off to the deal team. And this is the first time I think I've ever heard him raise his voice, because he's a very balanced person. And I'm paraphrasing, but you can imagine the language he used, where he's kind of like, why didn't you ask me for an intro, guys? I mean, we had a really good pass to play, but I didn't even know that sort of, the man was open. Like, why didn't you ask me for an intro? And they're like, well, how am I supposed to know that you're not part of the deal team? You sit on a board with someone who is an angel investor in this company and someone else who used to be the manager of the CTO, I believe, of the company. And I'm just thinking, if you just have all that information as a graph, you can totally know this, right? Because we can actually mine and buy data and stitch it all together to understand who's co-invested with who's worked with who, in what capacity, and was it a small company or a big company? Did they both do similar roles? Was in the same location? What companies have we invested in? Where do we sit on the boards? Who sits on which charity board? Who are our LPs? Our LPs, joint LPs in some GP that is actually earlier stage, which GPs or angel investors over the last couple of years, and especially recently, actually have been doing deals that are very exciting, who are rising stars at certain funds. Because I think a lot of the tier 1 VC, tier 2 VC, tier 3 VC is very circular. There's lots of funds that haven't actually done fantastic returns or deals in the last couple of years that people still deem to be tier 1 investors, whereas a tier 1 footballer is the best at their position. And if you used to be really good 3 years ago and now you deserve to be on the bench, then you're not a tier 1 footballer, right? But in VC, you can sort of limp around the field or have the perception that you belong on the field and should get picked for the national squad for much longer than I think is valid. So I had this idea that if we could leverage our network incredibly well when we wanted to get in touch with a founder, afterwards also we built the capability to get in touch with an LP or with an operator to do background checks or to do reference checks or to vet someone or to an angel investor, basically any sort of person or company. How can we mobilize the entire Dawn network, including WhatsApp relationships, calendar meetings, work experience, and not just direct, but even like, say, if I am good friends on WhatsApp with someone who has done an angel ticket in a certain deal, this doesn't show in any CRM, but it's actually extremely high signal. And I think it's a harder problem to solve, because even if you say we ingest calendar data without doing anything with mobile phone, VCs tend to be very sociable. So if you look at the relationship arc on a 2x2, then it starts with having a bunch of Zoom or calendar meetings. And then at some point you become close enough that you just give each other your WhatsApp. And then at some point you stop inviting each other with your work email, because it's weird. Like if we've known each other for years and years and we're WhatsApping all the time, it feels a bit odd if we're going to go for a run on Saturday to send you an email on your business email, right? So I think there's a lot of nuance in terms of how do you understand what is the real accessible network for not just a person, but for a firm and who they would know well. But this has been by far the thing that's actually helped us make more money, because both in terms of understanding who are the people that need to be real fans and advocates of Dawn so that we get access to deal flow better and we get tip-offs. Because the exciting thing about private markets is you can get information about a private markets company about, for example, hey, this company just signed some proof of concepts, and these proof of concepts are doing incredibly well. So these are going to become multi-million-dollar contracts. In private markets, that just means you're a good investor and you're well-informed. In public equities, you would hopefully go to prison, right? So I think private markets is really exciting in that sense, where if you do that well, you get access to deals, you win deals. And now whenever we get excited about a company, being able to punch in and give me 10 paths to Steve Budd and not just have it surface, hey, Ties has had 1 calendar or 2 calendar meetings with Steve, but actually there's people that we know that would have, maybe invested or worked together, or there's media coverage linking you and another firm together like this. It's just always, always valuable to be able to serve for the totality of the effective network you have as a firm to a given entity.
Thank you for going through and explaining that. How have the team, the humans, adapted to this? And how does that look in terms of the way Dawn operates? Has it changed beyond recognition? It'd be good to just understand what that looks like a little bit more.
So there's the old way of us trying to get in touch with a founder would be to put the LinkedIn URL of the founder in Slack and then say, can people please check their LinkedIn to see if you have mutuals that make sense? Now, There's many problems with this. First of all, not everyone is going to check on LinkedIn. And even if you would, on LinkedIn, you miss the calendar data. So you have an incomplete piece. Most importantly, second order connections in LinkedIn are so noisy that they're basically useless, right? Like for a lot of people that are sort of swimming in the same pool, and if you've been even in venture for 3.5 years, for any founder, there's always a whole bunch of second order connections on LinkedIn. The hard part is, well, which of those is going to be good enough that I can actually WhatsApp Oliver or Anna or whoever it may be and say, hey, you guys actually have a logical connection, or you guys actually have a pretty high probability of knowing each other well enough that I can ask for that connection. And that even I can ask Andrea, be like, hey, Andrea, I see that you did the same, student club for 2 years in a leadership position at Oxford as the chief of staff at that company now. Not just the CEO, but also everything around the CEO, or getting to board members, or getting to advisors of the company, or getting to angel investors. Like there's actually quite a lot more surface area to begin with than just the founder. That is very, very useful and very useful to influence. And even if you would just want to get to any of those people, being able to mobilize the whole thing. So in terms of how we try to get in front of founders, and even once we have met the founder, it's still incredibly useful to understand all the different ways. How can we get either information, or how can we get them to pick us over Axel or Sequoia? Because you understand all the surface area of that entity. So that piece is completely different with Rolodex. We're also much more, I think, intentional that everyone now has a clear wish list. We call this Rolodex coverage, where we're able to say, hey, there's someone at this fund that is either a rising star or a fantastic investor. And if they would be a fan of Dawn instead of neutral about us, that would benefit us. So one example of that is Begin Capital is a Dutch London-based fund. Love Begin, so without saying anything mean, I don't think they are most people's idea of a tier one firm. Or if you ask, hey, give me the top 10, 15 early stage investors, I don't think that many investors will actually say, hey, I've heard about Begin, because their brand isn't as good as their investing acumen. And there was someone there called Joelle, and Joelle had made general partner in very rapid time. So clearly, because it's also sometimes hard if you look at Crunchbase data, et cetera, to figure out who at the fund has done a certain deal. But if you know that the fund has done great deals, there's a bunch of deals that don't have clear partner attributed to them. And there's this one guy called Joel who's made GP in not much time. Odds are pretty good that Joel is someone that's been instrumental for the success of the firm in recent months, right? Another example of that is Oliver Cake's at Concept. So by using this data and by using this graph, we could say, well, it would be really useful if one of us would be good friends with Joel. And you can't force this, right? With some people you have a click, with some people you don't. It does give us a very intentional moment once a quarter saying, well, actually, if we're going to do events, we should start the invite guest list by inviting some of these people where it would be lovely if they liked us more. And that each person at Dawn, especially each investor at Dawn, should just have certain people that they are responsible for trying to increase the relationship with in a data-driven way. And Joel is actually the person that ended up then giving us the tip-off that Runware was doing outrageously well, and that they just hit this massive revenue inflection point, which allowed us to preempt the deal. And I think given it's in such a hot space, it's AI inference for video, and it's now done, I think, 6 to 100 million in revenue, something like this, in like a year and a bit. I don't think it would have been a certainty that we got to do that deal over, say, Sequoia, if we hadn't had the relationship and the tip off and gotten the timing right. Because we were able to put an exploding term sheet on the table that we wouldn't have felt the confidence for otherwise.
Yeah, so you perhaps become more purposeful in terms of the way that you're operating, and certainly proactive. I'm just thinking in terms of more practical steps that you took. And I suppose this is just the environment you're in with your portfolio as well. You've been building rather than buying. But was that just the way it's been, or has there been an opportunity to fast track something by looking what else is out there? But I'm essentially going to answer my own question here. There just wasn't access to something similar, hence why this was so unique for Dawn.
Yeah, so for Rolodex specifically, I think it used to be that people were aware that building great software that actually sparks joy and is useful and gets used a ton, is very hard and very expensive. And then now with Claude Code, I think the narrative has overcorrected a bit, where any 23-year-old with a Claude Code subscription can build Salesforce or Google in a weekend. And I think there's still a lot of middle ground there. In general, buying software is virtually always cheaper still, I think, than building your own and maintaining your own. So there's been a couple of systems that we've either just fully bought or that we ripped out then replaced because we said, hey, actually, we can get a very big improvement in the outcome or of the foundation if we just replace our finance system with a better finance system. And we just squeeze much more juice out of the new thing we bought rather than going into full build mode. That said, for Rolex specifically, I still to this day really don't see anything comparable in the market. And it kind of makes sense because private markets is pretty niche. And I think the problem is hard and it was a much harder engineering problem than I thought. It also quite frankly took almost a year before we really started seeing decent results, and then maybe another 6 months before it got used a lot and also really got us into a whole bunch of deals. It took longer for sure, especially ex-Google engineers tend to be pretty arrogant. They're like, how hard can it be? And pretty hard is the answer. So where you can buy, I think you should buy. But for something that it was so obvious that it made every core part of our business better, right? It now helps us get warm interest to LPs that we wouldn't otherwise. It helps us be much more strategic about when we plan travel. When someone has a board meeting in New York, who should they meet? Which founder should they meet? Which investor should they meet? Which LP should they meet? Rather than making this an afterthought. I mean, sending a GP to New York beyond the cost of the hotel and the flights, just based on their value for the org, is an incredibly valuable 3 days. So it seems absolute lunacy to me that at most funds, they sort of scratch themselves behind the ear 3 hours or like a couple of days before boarding. And they just sort of think, oh, who do I know in New York? Like, surely there should be a tech starting point that suggests, hey, there's 5 people or 10 people or 20 people, whatever it is, for these reasons that are exciting for you to re-engage or engage for the first time. And this is how you would set up a meeting efficiently. And this also now, the system works well enough that also, especially around travel, a lot of this work gets done by the EAs, which makes it even easier for the partners, right? It's just like they have a board travel or board trip. They say, hey, actually around the board, you should ask about those deals to that person. And you should try and squeeze in a couple of more meetings. And this, because it's so easy to do this and do this proactively, a lot of these meetings now also get scheduled much further out, which means the availability of the person's better because my calendar in 3 months, I'm like, absolutely, I've got time. My calendar next week, I'm like, oh God, Steve, please no.
Yeah, I mean, I'm building a network, I'm building a community. And one of the things I want to do is to not just leave it down to serendipity that someone meets someone down the corridor at one of my events and has a, really valuable conversation, because that may or may not happen. And so, how do you do something a little bit more purposeful and connect people in a curated way? That, that's something I'm doing at some scale, but, to the scale you're doing, I mean, we're talking about decisions that could mean a lot of money. And so
Absolutely.
it's highly, highly important. The one thing you have sort of found through this, and you talked about your 3-month probation, is that, that there was perhaps a rush to show some form of ROI so you could keep your job. But there is definitely out there at the moment, there's a frustration growing around the lack of quality ROI for all the investments that are being made. It's like there seems to be this sort of dual line at the moment, is that, well, we're spending more, but not much has changed in terms of cutting costs or additional value.
Yeah, margins or sure.
So obviously I'm talking more on the P side here, but what's your experience been, perhaps wider, and should we continue to be patient?
I think you should always have a healthy tension between patience and impatience with these things. I do think that the way that operational AI has been adopted in some engineering functions, where a lot of the thoughtfulness has gone out of the window and a lot of the deep thinking has gone out of the window, because just slap it in Claude code, and then if Claude says no, then I guess the answer is no. And I think there's a lot of people that over rely on this. Maybe one example is when I really have to write something thoughtful and original. It's not maybe too personal, but because I've only been married for a month, but I write poems to my wife once every month or so. And on paper, you'd be like, well, writing is something LLMs are really good at. I could just feed my previous poems in, and then in no time I could romance her over, and then I wouldn't spend so much time doing this. But I still find that if you really want to write something thoughtful and write something well, there's just this AI style of writing that is easy to pick out and gets very annoying. You see a lot of it on LinkedIn where everything has this like punchy first line and punchy last line of the paragraph. And it's just like, if any human would write like this, someone would hopefully slap them. Actually, it gets very annoying after 5 minutes. So I think for some stuff, you want to carve out time for actual deep thinking. And I think this applies to writing, which is why I still write these poems by hand. And same thing with a lot of the coding problems. When I really have a hard coding problem, I will actually walk away from the laptop just with a piece of paper. And I only get back to the laptop when I really have a plan of action or I have a clear thing that I'm doing. And then I force myself to only do that thing and then walk away again back to my piece of paper. I think there is a floppiness of thinking that has happened today because of AI, and because I think historically a lot of text you read on the internet, like on Google, used to be quite reliable. And I think now with AI, it looks, like text, therefore it must be true. And it's just not the case. That said, I think if you point it at the right problem, I think the gains of AI and technology widely are just massive, right? Like two examples. I mean, the most exciting thing is by far Rolodex in terms of actually helping us make money, because there's at least 3 deals that were surfaced, Access or one, or all of the above because of Rolodex. There's been a couple of deals where we were able to uncover ways to DD the extended founding team and uncovered some real red flags that meant we did not do that deal, which I think is also very valuable. And then on the operational stuff, quarterly reporting now, when I joined Dom, there were 400, 500 comments between the spreadsheet and the slide deck of people going, this number's wrong. No, it's not. Yes, it is, but it doesn't align with the board back. Yeah, but the board back actually uses LTM revenue. This uses endless, right? Last time there were 6, and actually the numbers were correct. It was just apples to oranges with one board back. So being able to prepare this kind of stuff and then being able to also analyze our portfolio and understand what is happening to margins in certain companies, what is happening to revenue growth compared to 2 years ago, what is happening to our cash position and runway in a way, and being able to interrogate the data. And the same thing on the IR side, being able to just have IR decks that are correct all the time, where there's no one needs to be chased about, is this the latest commentary? Like that whole workflow is just fixed. And being able to answer DDQ questions drastically faster. We were able to turn around a DDQ question because almost every question asked, actually, there was a variation that was asked before. It's not just a quad skill, but like we built our own thing because it doesn't work that well out of the box. But the end result is that now we can sometimes turn around a DDQ in 24 hours. And that's with both the IR VP and 1 or 2 of the GPs checking the answers personally and being happy with those. And because our whole spiel now is, hey, we operate better through AI and technology, I think it would really undermine our case if we couldn't then also turn around a DDQ very quickly. And being able to turn around these DDQs builds a lot of trust with our LPs and helps a lot of these processes move faster, right? But I also find it funny how on the deal side, every deal team is like, well, obviously a lack of speed is going to kill deals. But then on the LP side, people are like, well, it might take 2.5 weeks to get back to the question. 2.5 weeks? That's a long time.
So ROI is nuanced, and in this sort of phase that we're in at the moment, there's a balance to be had. But PE, especially, their portfolio, they are wanting to see what they would normally want to see, which is margin, EBITDA. And so it's something that they're really trying to squeeze out. Now, do you think this is a case that we haven't yet found the playbook yet? Is it because we haven't really got the operators that are able to diagnose and understand and prioritize where the portfolio should be heading? Do you think that there's an answer to this just yet? Or do you think it's a continued assessment? And we'll get into it in a moment in terms of building out the capability that can support portfolios better to try and identify. Because part of this has been around people as well. And a real gap that the PE is seeing is in mobilization is people. And so I just wonder, if there is something that we should be focusing more on that's going to deliver a little bit more of that, the answers to that EBITDA question.
So I'm very bullish on tech, and I think there's very few Ps and P people that I speak with. And I'm going to maybe add a big legal disclaimer here that I currently don't work in PE and I haven't done value creation with PE companies. So again, shooting slightly from the hip here. But I think what is a fact is that PE companies themselves have been pretty awful adopters of technology generally. And I don't think that the senior leadership at these PE firms has typically gotten promoted based on their expertise on technology and machine learning and AI and data and all that kind of stuff. And the opportunity for technology to do many, many, many of these processes just drastically better, to me, is irrefutable. So I'm very bullish on what's possible if you get the right operators in. I think getting the right operators into a PE style environment is tricky because PE culture and tech culture clashes quite aggressively. PE management style for an investment associate and for an engineer typically doesn't lend itself very well. The whole move very fast with relatively little supervision and potentially break some things lends itself very poorly to PE. And I think especially on the internal side, a lot of the PE projects have to happen quite quick. Like a deal moves quite fast, generally speaking. And a lot of the internal projects move quite fast, generally speaking. When a tech company says, okay, we're going to build a new capability or totally new product, or our case with Rolodex, it took probably 3 months, 6 months to have a thing I could call Rolodex. and then almost a full year of hard focused development where I just do internal tech, right? And I have a team, and this is really, the Rolodex has been 80% of what we do. Probably took a year and a half before I was like, yeah, okay, now it's clearly demonstrably an advantage for us, an edge that has gone us into certain deals that I can tie to money, not like time savings or whatever. Because if you give people time savings, they might just browse Instagram a bit more, just think play. Often you don't instantly see it in the margins. But really where I could say we've now built a piece of tech that other people do not have, that is only going to get better, that is making us more money. And I think that culturally is very hard to do in a PE environment, which is why not that many funds, I think, have done this very successfully. I think there's some exceptions. I think HG Capital is one of the very best at this. Some of the people that I met from the CBC portfolio value creation team I found very strong and impressive, and I've heard good things about. But I think in many ways to do this capability well, you can rely on external support, but you also really need the DNA to change at senior levels in the organization. And ideally also, not be a cobbler with broken shoes.
I think that's where the rise of the AI operator is coming, and seen it amongst the network, that there's been this rise of this role that sits in the PE firm, and they seem to appear to have, most of them, a dual role of internal initiatives as well as supporting the portfolio as well. We are coming to time, and I just wonder if we could just perhaps look forward a little bit more, maybe 12 months, whatever. It's really hard to to think too far ahead, but it'd be good to know what your sort of focus at Dawn is over the next few months, what that will be, and perhaps then also how your role will adapt as this sort of moves forward, how it's adapted perhaps up to now as well. Because it could be that the investment firm does things differently, that this role isn't necessarily needs to be dedicated over time. But yeah, looking forward and how the role might change would be a really good way to close us out.
So I think as a rule of thumb, I think it is much easier to do one thing well than to do two quite different things well, which is why if you are even a mid-sized fund, and Dawn is large for a VC with 2 billion AUM, but would be tiny for a PE. I think it makes total sense. And I think you should have at least one person fully internally thinking about this, wrestling with this, building solutions and driving them home and iterating on them. Just because I would not have been able to build Rolodex if I also had to do deals, if I was a 50-50 role. Or I think it's just very distracting. It's very hard to get the balance right to do end of year compensation and to do annual reviews. I think in private markets, relationships are an incredibly valuable asset. And I think the technology around how do you leverage these relationships, how do you figure out where you want to nurture? How do you figure out who are some of the highest leverage people that your firm is not close with yet? I think is and remains a superpower. And I think there's something around relationships and relationship intelligence and networks that I think is just totally undermined by private markets as a whole. I think there's a lot of work. I'm already seeing this at Dawn now where, we built our own plugin in Claude that has a whole bunch of nested skills and assets. And we built our own MCP as well for many services that basically helps you just use Claude for all the daily things you do much, much, much better than it does out of the box. So it is much more precise. When I say look at Fuse Energy to pick the right company, if I ask it to look at Steve Budd, that it is much more precise about finding the right Steve Budd and all the associated data that we already have in our data warehouse, that it can actually make slides that use the right font, the right style, the right format, the right build up, the right structure, so that actually anyone can just basically talk into Claude for 3 minutes, 5 minutes, and it'll have a slide outline that is just very strong, or throw an existing deck in and get kind of partner level critique and suggestions on how to make it better, I think is a superpower. And being able to do many parts of the diligence substantially faster than we could before. I think there's a huge amount of the operational work around deals that is going to change a massive amount. And then I think in the back office of these firms, whether it's quarterly reporting or LP reporting or legal stuff or answering LP questions, I think there's a way to think about virtually all of these processes, especially at the scale of HG, where you can really design them like how a tech native firm or an AI native firm, honestly closer to a Google than closer to a place that lives and breathes Excel every day, which is very exciting.
Well, look, I feel like one piece of advice, certainly if a firm is looking to hire an AI operator, it seems to be, is just be mindful that just bringing someone to look across internal and external is going to be really difficult for them to put a focus, and I assume they'll just get pulled into the deal discussions.
Yes.
So that focus is going to be pretty key. But for some, this would be their first hire, anything like it. So I suppose there is some form of learning curve to be done. But yeah, that focus is going to be essential to ultimately get the ROI that you want. Ties, look, it's been a fascinating conversation. Really, really enjoyed it. Thank you so much for your time today. And it's been a useful and valuable counterpoint to the PE-focused episodes that we've had previously. So thank you so much.
My pleasure. Thanks for having me, Steve.
To find more about Ties in the work he's doing at Dawn, and we'll put your details in the show notes. But that's it for episode 4 of the AI Operator series on this AI Pathfinder for private equity. If you're in a similar role, whether in PE, VC or portfolio company, we'd love you to take part. So give us a shout. But that's it for now. Thank you for listening.